Welcome, everyone. As you can see, Ben replaces Andy today, who is out on paternity leave, has a little baby boy about a week old now. Ben will cover the rough and volatile quarter we just experienced and how diversification proved of little benefit last quarter. Glad we're all through that little rough patch. Adam will address how our value lean helped us during that quarter, and we'll also address sort of the key market drivers ahead, which include inflation, the Federal Reserve, and labor markets. So Ben?
Awesome, thank you, Lowell. So let's take a quick snapshot of kind of the market over the last quarter, and we're also going to be looking more long-term as well, but kind of just focusing on the main general asset classes here. We can kind of focus on how, as Lowell said, diversification had little difference here, as there was perfect correlation to the downside between the US stock market, the developed international emerging markets, and even the global real estate and bonds as well. So as we kind of hit the end of 2021, we were, we essentially got lucky because we missed out on a lot of tax changes and rate hikes in the year 2021. So we were able to finish strong. So with that, we were able to kind of expect a little bit of volatility heading into 2022. And with that, we got that in the form of rising inflation, the Fed trying to combat that inflation and restrict the monetary policy, and also sprinkled in on top where it was, geopolitical fears from the Russia-Ukrainian war. So what's important to note is that while all the general asset classes were down, if you look at the bottom of the slide here, the worst quarter for each of these asset classes were much higher than what we just witnessed over the last quarter. So something we want to focus on, and mostly those happened in 2008. So something that, the outlier of that statement really comes down to the far right side of the screen, which is going to be the bonds, which are both domestic and global bond markets, saw their worst single quarter performance in about 40 years. So really what this has us is rethinking how we're kind of thinking about diversification, where, over the last quarter, we worked with our clients to kind of rethink the idea of diversification and looking through how stocks and bonds usually have an inverse relationship, where if one goes up, the other one's going down. And, as we saw in this last quarter, they're perfectly correlated together to the downside as well. So as we're kind of looking at this, it's kind of calling ideas to more of a broader diversification than outside of stocks and bonds. And that classic 60-40 stock to bond allocation is really not able to set out what it intended to do over the last many years and decades even. So as we look to add separate asset classes, we're looking to add non-correlated assets to the mix. And we can kind of focus on how the next 10 years will be likely different than the previous 10 years. So speaking of previous years, as we look to more of the long-term market summary, we can kind of see that over just the last 12 months, both domestic equities and international developed equities, held on to most of their gains that they had, even throughout all the volatility we saw earlier this quarter. Then on the downside of that, emerging markets is still stuck in this rut of, those economies are still trying to restart after getting out from under COVID and trying to crawl out under the COVID rock, as it were. Unfortunately, the geopolitical fears of Russia and Ukraine has kind of put more weight on that rock. So we'll keep monitoring as emerging markets continues to crawl out of that. And global real estate, with heightened inflation, kind of returned as expected, and they're actually the best asset class over that long time period. So one thing we want to kind of focus on for the long term is, as inflation continues to have effect on purchasing power in the market, and interest rates continue to affect bond prices, we want to kind of look at, we're coming out of a very high return environment, and we want to make sure we're kind of thinking about expectations a little bit differently, to be averaging more of historical averages. So with that, I'm going to hand it off to Adam, who's going to talk a little bit more about specific strategy, more on the economy itself, and things to look out for later on this year.
Great, thanks, Ben. And to really kick things off, I had ended up sharing this with a handful of clients throughout the start of the year. And I thought it'd be helpful to put this out there as a way to wrap up some of the observations that Ben made just generally about, what we experienced during the quarter. And, we came into this year with, a relative, sense of calm, let's call it. We got out of the pandemic fairly quickly in the spring of 2020. And then, from the back half of 2020 through all of 2021, it felt a lot like smooth sailing. And usually when you hit those periods, you start to sense a little bit of complacency in the markets. People are used to seeing their account balances go up every week, month, and quarter with little volatility. Really in the case of last year, the worst drawdown from top to bottom is only a couple percentage points. So, and that is in stark contrast to what we've experienced going back really since the start of when we've been able to track the markets. On average each year, we can expect a decline from top to bottom in equities of anywhere from 10 to 15%. And it naturally happens, almost on an annual type of basis. And when you have that sense of calm and then you transition to a more volatile market, it's a great point in time to remind yourself of some of the things that we've had to weather, even in the short term. So this is a list of some of the big headlines we faced coming out of the great financial crisis. And there's a lot of points along this journey when you've probably been able to say, this time is different, or, this is the beginning of the really next big market crash. But what the headlines tend to do is they tend to recycle themselves in different forms, and the markets behave however they anticipate, they need to behave. And you gradually over time as a long-term investor reap the rewards of that discipline. So these types of quarters and these windows of time, although, definitely, as I'll touch on, provide an opportunity for action and to reevaluate portfolio and make changes where it makes sense. It's a good check-in for our behavior and some of the things that we've had to, remind ourselves of some of the things we've had to experience. So each time really does feel a lot different when you're just focusing on the headlines themselves. And that's a great way to translate into a conversation on the economy. And one of the things that we do as investors is we like to simplify things. We like to take pieces of information and put them together and make comparisons to either past experiences or simplify them in a way that we can try and make it, have it make sense for us today at this point in time for decision-making purposes. But we're really dealing with a couple of big pieces of information and changes that we're going through across the markets that can be translated back to history, but need to be put into the correct context. So just in general terms, everyone agreed, you leave your house, you go out, you try and book a vacation, just like we've seen the last, let's call it 4 to 6 months. Things feel like they're back up and running. You try and, book flights, you're at the airport, you're making reservations at restaurants, you're trying to buy a car. I think it's pretty clear to everyone that the U.S. economy, especially, is back in action, and that's happening on top of and in lieu of some of the other headwinds we faced. Really, the obvious one this year has been what's happening in Russia and Ukraine, and on top of that, what we're seeing with inflation, we're seeing headline numbers and inflation, like as Ben was talking about the bond market and how that's been hurt from rising rates. Inflation being a big backdrop to that. We're seeing headline inflation numbers year over year that we haven't seen, since the early 80s. And so naturally we take that and we say, well, this is gonna be like it was in the late 70s and early 80s. But the current state of the American household and the consumer and the labor market is drastically different than what we experienced back then. So yes, inflation is uncomfortably high. It will stay a little persistent in its magnitude, at least probably for the next 12 months or so. But I would say that if you look at the numbers, we are well prepared to weather a lot of that storm, at the household level. You've got, a job market that anyone on here that's a business owner that's been involved in trying to hire someone, we've got almost a 2-to-1 ratio of job openings to people out there actively looking for work. And so the the labor market, naturally, when that happens, you see a rise in wages, and thus subsequently, the household savings rate and the financial health of households tends to strengthen substantially. And that's exactly what we've seen happen. The U.S. household is in better position, arguably. I mean, you could argue it's in a better position than it's ever been. And some of the things that have been really difficult to watch in terms of inflationary pressures, especially with energy, with what's happening in Russia. Certainly at the gas pump, we're feeling it and we're seeing it day to day. But the cost of energy as a percentage of our budget is substantially different than it was, back several decades ago. So yes, painful, an annoyance, and something that we're noticing. But when you couple that with the labor market that we're in, and with people's job security and financial strength at the household level, I think you get something that's it's putting everyone in a position to be able to weather that. And so I'll talk about that a little more in detail when we look at the undertone of what's happening in the stock market and what that means for investing. But in terms of our day to day and the economy, we're well positioned to get through that. And the other piece of this, certainly is around what's happening with the Federal Reserve and what we're seeing and hearing now. It's making headlines and a big discussion around, the office tables and dinner tables around interest rates going up. So, as they have telegraphed pretty significantly, and as we almost are expecting at this point, several more interest rate hikes throughout this year and a continued rise in rates. And certainly there's investment implications to that, and then there's the day-to-day implications of it. But the market is anticipating that. That's been extremely well telegraphed, and something that happened in the aftermath of the great financial crisis to a whole nother level is how transparent the Federal Reserve it is now today in terms of the minutes they release, the commentary. They're out there, they're speaking to the public. So the opportunity for surprise, it's always there, but it's certainly muted compared to prior periods when we were dealing with inflation and the prospect of rising rates. It's a different environment, just in general. We've got more information at our fingertips, and the Fed's adapted to step in and be a big part of that. So that's what we're expecting. You can argue, are they late to the game? Did they, were there mistakes that were made? Absolutely, that's a totally fair discussion to have. But I think at this point they've set the markets up to really be prepared and ready for that, really regime change from pumping trillions of dollars into the economy to trying to tighten things in an economy that will be slowing but still growing. And then finally, as we start to transition into the investment discussion, is what does that mean for earnings of corporations and subsequently stock prices? So a lot of the comparisons you make when you're hearing about earnings reports and how, S&P 500 earnings are being released, it's always benchmarked based on what either happened last quarter or really over the last trailing year. And so you can imagine coming out of the pandemic, earnings were depressed to a significantly and historically significantly low level. We had an incredible recovery off of that. So the bar has been raised, on a quarter to quarter basis for companies to really perform and deliver on earnings, expectations. And so, so far we're kind of right now in the heat of getting into earnings season, and you're still hearing a lot of positives across the board. And although it's not going to be the mid to high double digits earnings growth that we saw last year, it's still going to be earnings growth, and it's still going to be, again, going under that theme of a growing but slowly growing economy and earnings environment. So what does this all mean in terms of the investment implications and how we're really currently positioned within our equity portfolio specifically? You've heard us talk, Andy, Lowell, myself have talked a lot about, the size and style cycles and how we're positioned across, large versus non-large and value versus growth. And something that, caught our attention, about 18 months ago was the valuation gap in terms of growth versus value companies, and looking at them in terms of what's cheap versus what's expensive. And you've had, really let's call this a double-edged wave of the value resurgence after a long delay. And the first was, as we first, initially began to come out of the pandemic, the investment community realized, which was fairly apparent at that point, which is that if you look at the difference in valuation and pricing between growth companies and value, there's a historically wide disparity. So at first, it was just that value was very cheap, historically cheap relative to growth. And that was really the indicator and what really ignited our big move over to value. And you saw that. And then what happened in the middle of last year with the Delta variant is you started to see a wave back over to the stay-at-home stocks and the growth stocks. So that value rally got put on a little bit of a pause. But towards really through the second half of 2021 into this year, that has rotated completely, as evidenced by the most recent market correction, where you saw from top to bottom the S&P fall just under 15%, but it was really a tale of two markets underneath that, where growth companies were substantially punished, and the value spectrum held up fairly well. And so what's happening is the second wave of this is, first it was valuation. Value's just cheap. It is what it is. And now it's turned into value companies are not only still relatively cheap, but they're fundamentally poised to weather a lot of what's in front of us at this point. So when you think about inflationary environments, when you think about an economy that's starting to grow at a slower rate, people wake up and they start to favor good old fundamentals, profitable companies, a lot of them, in many cases, dividend payers, but companies that are fundamentally sound and fall on typically the value end of the equation. So that's what we're seeing now. That's really the two-part phase of what we've seen in the move over to value. And this is something that might look familiar to a lot of you. It's something we've shared, Andy has shared intermittently in prior webinars, but what we use visually to help determine, are we in a more of a value phase or a growth phase? So it's simply referred to in a lot of cases as the mountain chart. As you're moving up the waves here in the blue zone, you're in a pro value cycle. And as you move downwards below the axis, it tends to be pro growth. So you can see, if you follow things over to the right, what we saw from really 2017 through the pandemic into last year, a very uninterrupted almost growth cycle. And then now we've seen a very, very obvious to us, move into value. And these cycles tend to last 2.5 to 3 years in length, these style cycles, as we call them. So our continued position is that we're comfortably within a value phase, and are happy and confident with where we've got our equity portfolios positioned to participate in that and be a part of it. So whether you're purely in an equity portfolio or you're in a more of a diversified model, as you're working with your advisor and they're talking about the equity piece of your portfolio, that's something they'll continue to emphasize, as the value tilts within the equity allocation. And so as we head into the second quarter, a couple things to have on the radar that we certainly want to make part of our conversations and things to look at together is, first and foremost, it's tax time. So whether you were able to wrap up your return effective Monday or did it earlier or on extension, now it's the time to be thinking and talking about taxes. And so we're certainly here, and our advisors are here to help you not only evaluate what did last year look like, and were there changes or are there changes that can be made, but how do we look forward and now and start to really plan for 2022. So anyone that had any surprises or kind of their eyes opened up when they filed their taxes this year, know that really it's not about tax preparation, it's about planning, and the planning is a year-long endeavor, and absolutely leverage us to help you through that. The second thing is, you may or may not have seen this through your email box. We're almost in the middle of our Road to Retirement webinar series. So we've been doing, and we'll be doing through the summer, monthly webinars on very relevant retirement related topics. The first webinar was on just the psychological transition into retirement. The last webinar a few weeks ago was on taxes. And then the following will cover topics such as Social Security, healthcare, and other more detailed retirement talking points. And so those will all be recorded, and you should all be having the opportunity to register for those. And if not, please let us know. We'll make sure we get you signed up. And then finally, a couple things to have on the radar for the back half of the year specifically. Obviously, something that will be a talking point through the summer is the midterm elections. So that's something we're all pretty well aware of and we'll be prepared to discuss. And then the other thing in tandem with that is there was, I think this somewhat fell under the radar. It made some of the headlines, but wasn't as out there as the previous iteration of this. It's the Secure Act 2.0, which is some, I would say, fairly substantial retirement legislation related to things like changing the RMD age, changing how certain types of retirement accounts are handled. And it's the Ways and Means Committee released a big report on this, so it's starting to gain bipartisan support, and it likely will not get passed in its current shape and form, but it's out there and there's discussions about it. And so we'll be tracking that and communicating any changes or how this might relate to clients individually. But just know that there's something in the retirement space out there lurking, and might be a relevance for us to be speaking with you about. So that wraps up we're just coming up on the half-hour mark, a few minutes early, but that wraps up the prepared portion of the webinar. This will be recorded, and as always, we've got our advisors on hand if you need to talk about any of the material that was presented, taxes, or anything else that you feel might not have been addressed today that would be of relevance or of help to you. Please feel free to reach out and let us know. So appreciate everyone joining us today.